Hi, I'm Tiffany Fykes with the Fykes Realty Group, and if you are in the market to buy a house in 2026, as we're about to enter 2026, I am sure you have heard about something called an assumable mortgage. And while it may sound promising, especially with rates higher than they were a few years ago, most buyers don't actually know what it takes to assume a mortgage, and so that's what we're going to break down today. So I am getting a lot of questions about this. Our team is fielding a lot of questions because, last time we checked, rates were around 6.3%, and we talked to somebody who is keeping their house and renting it, who bought their house, I think it was in about 2021, and they had an interest rate of 2.35. It's the lowest I have seen in my history in real estate. And so you may think, oh my gosh, that would be amazing to lock in on a rate that is 2.35. And you're not wrong, but I want to make sure that you understand how it works, what the cost is, what it really takes. So, what's an assumable mortgage? Not all mortgages are assumable. What assumable means is a new buyer can take over the mortgage. That means you take over the interest rate, you take over the payment, you take over it being due on the same time it was due for the people that you took it over. FHA, VA, and USDA loans are all usually assumable. Conventional loans are not. But here's the part that most people miss. It's not like you can just say, hey, Mr. Seller, I'm just going to start paying your mortgage. They can't just hand you their mortgage. You have to qualify for it, just like you have to in any other mortgage. And you've got to plan accordingly. So what are the benefits? Obviously, the benefit is if you could get a 2.34% interest rate, that's pretty phenomenal. You can lock in yesterday's rates today. And here's another plus. Assumptions come with fewer loan origination fees, which also reduce your closing costs. So overall, it's financially great. Now, how do you qualify for an assumable loan? Number one, you need to have a steady income. This is just like any loan. Credit score that meets their minimum requirement. You've got to have debt to income ratio typically between 43 to 50%, and you need to have proof of funds for the equity difference. Now that's one of the big things. If you're buying an $800,000 house and they have a $400,000 mortgage, you have to come up with the $400,000 difference, and you have to show the bank that you can come up with that difference. So if you don't have cash, it's hard to get that. There may be some options, but lenders are not really excited about assumable mortgages. They'd much rather give you a 6.3% interest rate. And so you've got to make sure you're ready to prepare all the tax documents. You want to tell your lender early that this is something that you're interested in. And here's the thing to know that to me is the most, detrimental is not the right word, but hardest thing to overcome. These take a very long time. 45 days kind of minimum. I've seen them take up to 90 days. So if you're in any sort of hurry to purchase, assuming a loan is probably not going to be an option. Those are the pluses. Those are the minuses. When does it make sense? If you can lock in a really great interest rate and you have the cash to cover that gap, and you plan to stay in the house long enough for it to have made sense for you to, you're going to pay those payments long enough. It's probably going to be more than a couple of years. You need to plan to be in that house for a long time. You've got your monthly savings to justify the upfront cost, and you want that lower closing costs. That makes sense. And if you're a seller that has an assumable mortgage, it makes sense for sure to market your property, even though there's some disadvantages with that assumable loan, because it could make your property stand out from one of the other ones on the market. Assumable mortgages are not magic, just like a 50-year mortgage, maybe we'll talk about that in my next video, is not magic. It's not a shortcut, but there is a real advantage if everything lines up for it to make sense. So if you're looking at a home with an assumable mortgage or wondering whether your own loan that you have on your house could attract more buyers, reach out for a strategy session with our team and we'll help break down all the things that you have to consider. Because the right guidance can help you avoid surprises and decide whether assumption is worth pursuing.